Welcome. In this video, can XCN be 50 cent? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
First, it should be noted that such a descending trend structure is present on the chart, and that the price is moving under the pressure of this trend. A descending trend actually indicates that sellers have been more dominant in the market for a long time, while buyers have struggled to push the price upward. Because if a chart consistently forms lower highs and lower lows, this tells us that sellers are in control and buyers have not been able to fully assert their strength. However, it should not be forgotten that no trend structure, whether upward or downward, lasts forever. At some point, it either breaks or weakens completely, giving the price a chance to change direction. This is where the presence of a major descending trend line and the need for the price to break above it becomes critical. Because a major descending trend acts like one of the psychological barriers in the market. Along this trend line, investors may have repeatedly sold at similar levels, which strengthens the trend even more. But each time the price approaches this trend line, new hope and expectations arise in the market. If the price can break above this descending trend line, it signals not only a technical breakout, but also a major shift in market psychology. When this breakout occurs, it becomes clear that buyers are now in a stronger position while sellers are gradually weakening. Because the long-standing pressure of the trend line has been overcome, this can be interpreted as the beginning of a new upward trend. In such a situation, a major change occurs in investors' perception. A breakout after the price has long been moving under descending trend pressure can call investors who had previously stayed out of the market or remained undecided to return. At the same time, investors on the selling side may be forced to trigger stop-loss orders or close their positions. This creates upward pressure on the price. When the breakout of a major descending trend is supported by volume, it increases the strength of the breakout and boosts investors' confidence. Because it's not enough for the price to simply move above the trend line, the sustainability of that move is also very important. Sustainability is confirmed when, after the breakout, the price does not drop back below the same trend line and is able to hold above it. Breaking a major descending trend also brings up one of the most important concepts in technical analysis: trend reversals. Trend reversals are often harbingers of major moves, so if the price breaks this trend line, it becomes possible to talk about the start of a longer-term uptrend. Especially after a prolonged decline, trend breakouts can trigger strong upward moves. Because this breakout both technically shows the strength of buyers and psychologically inspires confidence in investors. Since human psychology is the core factor shaping charts, this newfound confidence helps the price gain momentum. Of course, breaking a major descending trend alone may not be sufficient. After the breakout, it is also very important for the price to retest the trend line and confirm it as support. This confirmation process is a stage that proves how strong the buyers are. If after breaking out, the price returns to the trend line, holds there, and then gains upward momentum again, this shows that buyers are moving on solid ground. Such a scenario is received very positively by investors and makes the trend reversal more likely to be permanent. On the other hand, breaking a major descending trend can have significant implications not only technically but also in terms of fundamental market dynamics. Because when an asset that has long been under pressure experiences a trend breakout, it encourages new investors to enter the market. Especially those who closely follow technical analysis often see such breakouts as buying opportunities. This leads to additional demand on the price. As demand increases, it becomes easier for the price to move to higher levels. Thus, breaking the trend line can work like a domino effect, bringing larger upward moves with it. Moreover, breaking a descending trend may not only signal a short-term breakout, but also a long-term reversal. If the trend structure is monitored on larger timeframes, such as weekly or monthly charts, the impact of this breakout becomes much stronger. Because trend breakouts in large timeframes indicate that the general market direction has started to change. In smaller timeframes, breakouts tend to produce more short-term moves. Therefore, breaking a major descending trend helps investors adopt a positive outlook for the long term. Especially in technical analysis, a descending trend line is like one of the biggest tools sellers have. Because as long as this line exists, sellers can keep the price under constant pressure. But the moment the price breaks this line, sellers lose that advantage. The weakening of sellers leads buyers to act more boldly. This courage brings new energy to the market and helps the price move upward more quickly. That's why breaking a major descending trend is always considered a positive development in the market. To better understand this process, we can think of price movements like a river. A descending trend is like a current that constantly flows downward in this river. But at some point, a strong dam is built in front of this current, and the direction of the water begins to change. Breaking a major descending trend is like putting such a powerful dam in place. The flow of the price changes, the direction turns upward, and a new balance begins to form. This balance develops in favor of the buyers. In conclusion, breaking a major descending trend line on a chart is one of the most important reversal signals in technical analysis. This breakout shows that buyers are gaining strength while sellers are starting to weaken. It also creates a significant shift in investor psychology, bringing confidence and optimism to the market. If the breakout is supported by volume and the price maintains its position above it, the foundations of a long-term upward trend are laid. Therefore, saying that the price must first break such a major descending trend represents a highly positive expectation for the future of the market. But we can't make decisions based on trends alone, so let's look at the other metrics as well. Stay tuned.
When a bullish order block forms in the area where the price is located, it actually shows that strong buyers are stepping in, indicating that in the past, the price reacted sharply from these levels and made an upward move. Order blocks reveal the buying and selling activities of institutional investors, what we call smart money. This is because large volume trades are usually executed at these levels, causing the price to move strongly from that point. The fact that the price is now returning to the same levels, meaning reaching the bullish order block, actually means that the region where buyers acted very strongly in the past is being tested again. For this reason, bullish order blocks generally act as support, and it is considered highly likely that the price will react upwards from these levels. If the price manages to bounce from here, it signals that buyers are stepping in again and that the market wants to start a potential upward move. The fact that order blocks work in technical analysis shows that price action is shaped according to market psychology and the strategies of institutional investors. The most important feature of a bullish order block is that it forms at levels where the price previously initiated a strong upward move. In other words, at that point there were very significant buy orders that pushed the price upward. This force may renew its buying when it returns to the same region, or other market participants may also see this level as a critical support zone and open new long positions. As a result, a bounce from that area becomes almost inevitable. In other words, a bullish order block not only carries the traces of past price action, but also serves as a strong guide for future price direction. This is because market participants generally respect historical levels and give strong reactions again in the same areas. If the price is currently within this bullish order block, this zone is critical in the eyes of investors. A reaction from here may not only be a short-term bounce, but also the beginning of a medium and long-term rally. This is because the signal given by order blocks is much stronger than that of a simple support level. Normal support zones are usually based on the observations of retail traders, while order blocks directly reflect the movements of large players. This means that if the price starts bouncing from this level, there is real buying pressure from large capital behind it, which can trigger a sustainable upward trend. This is why technical analysts see bullish order blocks not just as simple support areas, but as key elements that can determine the market's direction. If the price bounces from the bullish order block, it is highly likely that an upward rally will begin. This is because such areas are where buyers regain strength and gain the upper hand over sellers. In particular, when the price reaches this area, trading volume increases and strong momentum develops. As momentum builds, retail investors also join in, pushing the price upward quickly. This usually happens in a short period of time, as order blocks have the characteristic of directing price sharply. These sharp moves attract investors' attention and encourage further price increases. In other words, a bounce from a bullish order block can trigger a chain reaction that starts a bullish wave in the market. These levels are also very advantageous in terms of risk-reward ratio. This is because traders place their stop-loss orders just below the order block, which minimizes risk. If the price reverses upward from the bullish order block, the potential targets are much larger while the risk is quite small. This is one of the ideal scenarios for traders. This is because there is both the support of institutional investors and technically a strong base forming. Therefore, a bounce from here is very important not only technically but also from an investment psychology perspective. Understanding how the price interacts with order blocks actually means understanding the nature of the market. This is because these areas not only tell us where the price might bounce, but also show the balance of power in the market. A bullish order block is a point where buyers are stronger than sellers. When the price returns to that point, it is expected that this balance of power will come into play again. If buyers are truly strong, the price will not easily break that level and will continue its upward move. That's why investors follow bullish order blocks to gain strong clues about the main market trend. The functioning of bullish order blocks often gives positive signals that the trend will continue. If the price is in an uptrend and finds support at bullish order blocks during pullbacks, this shows that the trend is continuing in a healthy way. This is because price never rises in a straight line, there are always corrections in between. Where the price finds strength during these corrections is very important. If this strength comes from bullish order blocks, it means the trend is built on solid foundations. In other words, the bullish order block at the current price level is critical not only for a temporary bounce, but also for the sustainability of the trend. From a psychological perspective, bullish order blocks are also of great importance. This is because these levels leave a strong impression in investors' memory. Since the price previously made a sharp upward move from this area, investors see this point as a kind of safe haven. When the price returns to the same levels, the majority of investors tend to buy with the thought that it will bounce again from here. This collective perception actually becomes a self-fulfilling prophecy, and the price really does rise from there.
One of the most commonly used structures in technical analysis of price movements is ascending channels, and these structures are particularly useful in identifying the direction of the trend, the potential range of price movement, and possible targets. An ascending channel forms when the price fluctuates upward between a defined support and resistance line. In such structures, the lower line generally acts as a strong support level for the trend, while the upper line represents the area where price faces difficulty and increased selling pressure over time. The midline is positioned right in the middle of this channel and often serves as an interim target. In other words, when the price reaches the midline, it may react from there or break through it strongly, accelerating its move toward the upper line of the channel. In the current situation, the price moving toward the upper line at the 50-cent level after passing the ascending channel's midline is a strong example of the basic logic of this formation. Ascending channels generally reflect the dynamics of bull markets. The price consistently makes higher lows and higher highs, maintaining the channel. This shows that buyers dominate the market and that after each wave of selling pressure, the price recovers from higher levels. Thus, movements within the channel actually reflect market psychology. Breaking through the midline indicates that investors' indecision has been overcome and a stronger buying appetite has emerged. This is because most technical analysts and traders monitor the midline as an interim resistance level, and when it breaks, they interpret it as a buy confirmation. This breakout often leads to an increase in buy orders and pushes the price quickly toward the upper line. This is why targeting the upper line at 50 cents is considered a very reasonable scenario. One of the factors that comes into play, especially when the midline is broken, is volume. If trading volume increases during the breakout, it proves that buying pressure is strengthening and that the price is likely not just making a short-term upward move, but instead has a higher probability of continuing steadily toward the upper line. Investor confidence also increases at this point because low-volume breakouts are often considered traps, while strong volume breakouts are signals that the trend will continue. For this reason, the most important confirmation for the path toward 50 cents is a midline breakout accompanied by strong volume. Another important point to consider in ascending channel analysis is psychological levels. Levels like 50 cents act as natural resistance points in the minds of investors. Many investors place sell orders at these levels, so when the price reaches them, short-term pauses or pullbacks may occur. However, steady progress within the channel and a strong momentum gained by breaking the midline indicate that these psychological barriers may be more easily overcome. This is seen more often during bull markets because buyers dominate the market and selling pressure is absorbed quickly. Another crucial factor in the scenario of the price reaching 50 cents is risk management by market participants. Purchases made along the lower band of the channel target higher levels for profit-taking after the midline is broken. This naturally creates strong demand toward the upper band. Especially when the price settles above the midline, it allows investors to raise their stop-loss levels, secure their positions, and operate more comfortably. This situation increases market confidence and allows the price to reach the target with less volatility. The break above the ascending channel's midline has a psychological dimension as well. It shows investors that the market is healthy and strong. Testing and validating the lower band, bouncing from it, and then breaking the midline reveal how solid the trend is. This further boosts investor confidence and creates the perception in the market that this time we're heading for the upper band. Once such a perception forms, market participants buy more, and this drives the price quickly toward the upper band.
Reaching the upper band of the ascending channel is significant not only technically, but also in terms of investor psychology. When the price gets there, it marks the completion of the short-term target for most investors. However, for long-term investors, this simply signals that the trend is continuing. If the price breaks through the upper band at the 50-cent level with strength, it could also mark the beginning of a new upward wave. This is because channels are often part of a trend, and breaking the upper band can lead to the trend continuing at a steeper angle. For this reason, the move that starts with the midline breakout may not only target 50 cents, but could also be the harbinger of a rally toward higher levels. The reliability of channel formations is widespread among investors because these structures show that the market is moving in a regular and predictable way. Instead of random price movements, following a disciplined and systematic trend helps investors make healthier decisions. In this context, a midline breakout is not just a technical detail, but also a sign that the market is functioning in a healthy way. This strengthens the likelihood that the price will reach 50 cents. In conclusion, within an ascending channel formation, it is completely natural and a technically strong scenario for the price to break the midline and move toward the upper band. As long as the price maintains stability above the midline, seeing the upper band at the 50-cent level is highly likely. During this process, factors such as trading volume, momentum indicators, and investor psychology will support the price's journey. Therefore, this analysis points not only to a short-term target, but also indicates that the market is in a healthy trend. This process, which begins with the midline breakout, strengthens investor confidence and accelerates the price's rise toward the upper band of the channel. Thus, the 50-cent level becomes not only a technical target, but also strong confirmation of the market's bullish inclination.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.